Alex Cole, my dear friend. It's November 17th, 2022. How are you this afternoon?
I'm doing very well. Nice to see you again. Just saw you last night.
Absolutely. I hope that the trip over to the UK has been a good one. Taking care of family is very important, and we can't wait to have you back stateside. But as you mentioned, yesterday's talk, for all of our StockCharts TV viewers, really appreciate you tuning into this weekly show where we really focus on the market environment that we are all investing and trading through. But it's important to also take a step back from time to time and focus on the process and the tools that we can use to better improve our process as investors. And so yesterday was a deep dive into the GoNoGo squeeze indicator and the idea of volatility compression. If you haven't had a chance to watch that, I highly encourage all of you to head over to GoNoGoCharts.com. You can watch the free replay of yesterday's StockCharts TV exclusive right there. But Alex, as we do every week, let's dive into the markets, starting with a GoNoGo cross-asset heat map. Let's take a look at what's happening in this rotation to amongst the asset classes.
Yeah, and you can see that really it's sort of been a couple of weeks now where we've seen things start to change. You can see the top panel here is equities, and we started to see these Go colors creep in, and now we've got an uninterrupted string of blue Go bars this week. So good to see that trend so far persisting. We'll see if that ends up being another relief rally or if we can move on to something more long-term. And commodities as well. A lot of people talking about the how bullish they are on commodities long-term. So good to see commodities holding their Go trend for a couple of weeks. Treasury bond prices have painted a couple of amber bars over the last few days. So that's interesting as well. We'll definitely watch that. Now, remember, that's bond prices, so they move inversely to yields. So that represents a bit of a cooling off in yields, which might be helping to drive these equity prices. And then down at the bottom here, the last panel, the dollar really has rolled over hard and is painting strong purple no-go bars. And again, providing some relief, I'm sure, for equity markets.
Absolutely. Alex, let's turn our eye over to the S&P 500. Take a look not just at the trend conditions, but also at the complete GoNoGo chart, looking at that momentum oscillator in the bottom panel, the GoNoGo oscillator. For everybody who is new to this idea, what we're trying to do is blend a lot of technical indicators to capture the weight of the evidence, or that responsible checklist approach to trend following, but remove the clutter from our charts. So we compute all of that heavy mathematics in the background. We represent trend conditions in this simple color-coded chart. Alex, talk to us about what we're seeing in this more recent rally in the S&P 500.
Yeah, it's a really nice example of how all of the GoNoGo components have sort of acted together to tell us, or sort of to describe what's happening in the markets and to tell the story of this recent rally. And you can see back here when we were in a no-go trend, we were making lower lows, but the oscillator made higher lows at that point. So that was our first sign that something might be happening that would cause the no-go to struggle. That's, of course, bullish divergence. And then we see the oscillator then break above the zero line into positive territory. And that is really a serious threat to the no-go trend. Because remember, if that trend is healthy, we're going to see excessive selling in a no-go trend, but any kind of enthusiasm of buying or excessive buying really doesn't make a whole lot of sense when you're in a no-go trend. So that is our leading indication that something might happen to the no-go trend. And then, of course, the GoNoGo trend indicator starts to paint some different colored bars here. We see a few aqua, and then we see an amber as well, as the oscillator then retests the zero line. So remember, that zero line is our objective level that can be used as support in an uptrend or resistance in a downtrend. So nice to see the oscillator quickly retest this zero line and find support as it heads back into stronger Go colors. And that's what gives us that green circle. That's a Go trend continuation icon telling us that the Go trend is in place and momentum is now surging in the direction of that trend. So pretty nice looking chart for equity markets. We could also see that we came down today and tested price levels that were resistance back in November earlier in the month, and also support back here in September. So that's the concept of polarity as well. So all the components really sort of playing nicely together there on this chart.
Absolutely. We've talked to a lot of clients who are perhaps feeling uneasy about the relatively narrow price range of trading this week. It's felt like a quiet, sleepy week here in the U.S. equity markets relative to the recent volatility that we have experienced. So, Alex, let's just jump this out to a weekly view. As we always talk about multiple time frame analysis, we need to understand the primary direction of markets. So, on a weekly view, this recent rally has not been enough to pull us out of no-go trend conditions on the S&P 500. We still turn our eye directly to the GoNoGo oscillator. We've been below zero, right? So negative momentum, enthusiastic selling through that downturn in September and October, but back up at the zero line in neutral territory, building a GoNoGo squeeze as we're on the pink bars of a weaker no-go trend condition. So curious inflection point on the longer term time frame as we think about how we would position ourselves going into year end. Be very encouraging to see this longer term trend conditions change back to a go trend. First signal will be the GoNoGo oscillator breaking above the zero line, which would give us the constructive indication that things are moving in that direction. Alex, let's turn away from the S&P 500 and check in on some of the macro forces that are affecting the U.S. equities rally right now. Let's start with a chart of the TNX, 10-year Treasury yield. We know that has been a serious headwind to risk assets around the world. And here we are in the recent days falling out of go trend conditions. Talk to us a little bit about what you're seeing on this chart.
Yeah, and of course, like you said there, when you're looking at the longer term picture, you want to keep it in context, and it depends completely on your time frame, right, and your risk horizons and what you're trading. These movements on the daily chart may well be long enough for you to be trading these movements and stepping down in time frame from there. But we like to give that longer term perspective as well, just to get a sense of where the markets have been and where they're likely to go. For Treasury rates, we've been in a rising rate environment for the whole year now, and you can see that during that time there will be some counter trend correction. So I guess the question is this a counter trend correction or the start of a really deeper move into a no-go trend? So you can see that we had these higher highs in price. We had the oscillator ride the zero line, build a go-no-go squeeze, and then break below zero right ahead of this change in color. So absolutely, in the short term, this is going to be probably a good thing for equity prices, but let's keep it in mind just in terms of whether or not this is a correction within a larger go trend. If you threw this onto a weekly chart, you'd see what I mean. But absolutely. Definitely things have moved against the go trend here quite significantly.
Yeah, and those intermarket forces that impact our equities markets have certainly cooled off from there. Yeah. Really stellar, durable, and profound runs here in 2022. Not only Treasury yields, but also the U.S. dollar. Let's take a look at, we use an ETF, the UUP, for the dollar index proxy, falling out of that go trend condition that it was just so persistent and baffling for many analysts. Now in strong no-go conditions on a daily basis. Alex, what are you seeing here?
Yeah, I mean, you can see the general movements of the U.S. dollar for really the whole year. And then we topped out and we started to move into no-go colors. What I'd like to draw your eye to is as we zoom in here, you see this topping pattern, this consolidation, a correction against the trend after this counter trend correction arrow. And look what it did to the oscillator. So except for this little blip here, you can see how the GoNoGo oscillator has been riding the zero line for such an extended period of time. And then this GoNoGo squeeze that built to its max was eventually broken to the downside on some heavy volume. And that coincides with the first of these, the GoNoGo trend colors to move out of the go trend, and we paint an amber go fish bar. And again, just like we saw in equities, we see that retest. This is a very important concept that what was support becomes resistance. And often when things are broken, they get retested. Mm-hmm. So we see that break below out of the squeeze into negative territory, and then that retest of the zero level. You know, we're looking here, will this go trend continue? Well, when it comes back, we'd need to see it break the zero line into positive territory, but it doesn't. It retests and gets turned away. And then, of course, that really sets us up for the strong move into no-go territory on heavy volume. So a really bearish picture for the dollar at the moment on a daily perspective. Strong no-go bars, turned away by the zero line, volume picking up as we move into negative momentum.
Absolutely. Predecessors and smarter men and women before Alex and I have given very funny names to investor behavior that shows up on charts, like a dead cat bounce. So within a downtrend, you see those relief rallies, the phrase meaning that even a dead cat will bounce when thrown from far enough heights. We see that retest, and that's just so common in terms of how institutional investors will exit those positions, right? So the first leg down is the warning. We come back to retest the zero line from a momentum perspective. Momentum gets to neutral, price reaches back to retest a prior high, and then we see the final plunge. So in terms of an investment perspective, Alex, we're right at an area of congestion going back to earlier this summer. Talk to us, maybe even from a weekly perspective, about what we could think of from a trend perspective and key areas of support and resistance here in this U.S. dollar trend.
Yeah, so absolutely, and I'm glad you asked for the weekly chart, because you do have to keep everything in perspective, as we mentioned, and you can see that on a weekly chart, this is a correction in a go trend. Now, having said that, this is quite a steep correction, but you can see how it is a correction within a go trend, and how the oscillator has stayed at or above zero for this entire time. So throughout this really strong dollar move from summer of 2021, look how the oscillators found that support at the zero line over and over again. Every time we consolidate or correct against the go trend that moves up quickly, consolidates, we've found support at the zero line. So here we are again. Now, to me, just from using my eyes, this looks a little different because of the size of the sort of the volatility of this correction. You can see how each correction has got a little bit more destructive as we move through the trend. But we are, of course, going to turn our eye to the oscillator. We don't want to just use our eyes in such a subjective manner. That would go against everything we believe. So we're going to look to this zero line here. And if this holds, then we may well see on a long-term chart the go trend persist for a little bit longer. But if it breaks this zero line into negative territory, that would really confirm what we're seeing on the daily chart.
Yeah, and certainly any relief off of that strengthening, right? Even just a reversal of the rate of change has certainly been a tailwind for this recent relief rally. Alex, let's turn our eye to some of the other macro forces at play. I want to turn to gold. GLD is the ETF that we can look at. Obviously, a lot of different ways to express a thesis in the gold trade. Let's start on a daily basis, and we'll jump back out to the longer time frames. But gold has broken out of this very long-term, persistent no-go trend. Yeah. Obviously, the macroeconomic textbooks that I had to read through in business school suggested that gold would be a great flight to safety. It has always performed well in a rising rate and inflationary environment. And it's been nobody's friend in terms of what we have seen in this recent cycle until just now, breaking out of that no-go trend into positive territory. What really leaps out on this chart for you, Alex?
Well, there's a lot that jumps off the chart. It's nice to see color change on a break of a significant level, and I threw that trend line on there just because you can see how those lower highs seem to be connected, and then we get that break on the amber go fish bars and now into the go colors. You can see also how we had bullish divergence, oscillator making higher lows, price making equal or lower lows. And then when we did break above the zero line on heavy volume, then that leads us to this go trend taking shape. But also what jumps off the sort of the chart to me is just the way we really don't have any idea what's going to happen in the future. We talk about not knowing what's on the right side of the chart, right? And I think that's something to keep in mind. We don't know what's over here until it happens. But what gold does in response to the equity markets or to the current environment, really, we've had a hard time, people in the industry, predicting, would it be a flight to safety? Would it not? I mean, right now, it seems to be almost trading like a risk asset, right? It's moving much more in line with the equity markets. So really, I guess the point to make is to try to stay away from all of the market noise and the analysis, the talking heads, and really sort of stay focused on what the market is telling you. And right now, gold has broken out, like you said, is in a go trend, and we're in positive territory on the oscillator. And for whatever reason that is, that's what gold is doing.
Absolutely. Let's jump this out to a weekly basis, if you don't mind, Alex, just to get a little longer term perspective on where we are coming from and what that recent rally looks like from a longer time frame view.
Yeah, I mean, and this is the year sort of to date, right? Going down as rates have risen, which is what surprised so many people. Now, what is important here is that this weekly rally over the last couple of weeks has caused the oscillator to break above the zero line. So only barely, but instead of getting rejected at the zero line as it did here, it's broken above in positive territory barely. So, yes, the larger time frame trend, the weight of the evidence says it's still a no-go, albeit weaker, but it is above positive territory on the oscillator. So that's a sign that perhaps the no-go trend isn't that strong. Also, interestingly, I'm zooming in here a little bit because that looks like it might end up being a doji, right? So a little bit of uncertainty with the markets in gold in general and why they're doing what they're doing.
Absolutely. So we've checked in on some of the macro forces. Let's dive into the S&P 500 and get under the hood here with a GoNoGo relative strength sector RelMap, where we're looking at each of the sector ETFs of the S&P 500 relative to their benchmark. Some pretty fascinating things happening. Certainly, we've seen consistency in the cyclical sectors of the market, showing the relative outperformance against the benchmark. But XLK, information technology, peeking its head up, and certainly we've seen a stronger relief rally in some of those mega cap growth names that did so well throughout the pandemic stay-at-home trade. Alex, on a relative basis, seeing a little weakness in the trends of the outperformance, but tell us a little bit about what you're seeing from a relative strength perspective.
Yeah, I mean, it's still the middle of the chart that's leading. You can still see that it's the middle of the chart that's giving us the outperformance. It's energies, financials, industrials, materials. But there, as you said, there is some change creeping into the picture. Down the bottom here, you can see some underperformance from some of the more defensive sectors like healthcare and staples. Utilities, of course, has been underperforming for a while. So that's interesting and perhaps a good sign for those looking for, the next bull move. And of course, I would be wrong of me to ignore the aqua go bars on a relative basis for technology. So technology coming back into leadership is always something that people welcome. And we'll watch the chart to see how that develops.
Absolutely. Certainly, the fundamental story always makes sense in hindsight. One of the reasons that Alex and I are such firm believers in technical analysis is that we don't often know in real time what fundamental factor is going to drive long-term trends. Certainly, we can all read the same news, and we've heard of a lot of layoffs from mega cap tech companies along the western coast of the United States, and so that may have appealed to the senses of some institutional investors that are looking for higher profitability as they have been cutting costs. But let's not speculate about the why and instead just react responsibly to some of these market moves. Alex, let's dive into a couple of the individual sectors, starting with the XLE, the energy sector. We'll look at it on a daily and weekly basis, and then we want to look at those relative strength ratios as well. Starting with the daily, strong uptrend for energy. Obviously, this was the highest performing sector in 2021. It's been an incredible trade in the first half of 22. Certainly collapsed a bit over the summer, and yet we are back at all-time highs. And the oscillator has remained above zero despite the counter trend correction arrows there on the right side of the chart.
Yeah.
Anything that's really jumping off to you in terms of the longevity of this trend?
Well, these are the areas of sort of struggle that you were talking about in the summer, where really couldn't find a direction. And now we seem to have emerged from that in a go trend. And as you said, we've made some new highs here, which is important. Right now, we are actually just about at the highs from June, from earlier in the year, but the oscillator testing the zero line from above. So we will watch, and we want to make sure that we see the zero line hold as support if we are expecting an attack on prior highs. But you can see how much stronger this chart looks than the chart of the S&P as a whole, right? Look how much higher price is relative to where we've been all summer. So definitely a stronger chart, and we're going to pay attention to the zero line.
And let's take a look at this on a weekly basis as well, just for that longer term perspective of the trend that began in 2020.
Yeah, look at that. I mean, that is a great trend. You can see that most of, generally speaking, we've stayed above the zero line. This is the summer correction where we really did dip below zero. But this is what we were talking about before. The retest works both ways. We broke below zero and we came back to retest it. But then when we really climbed out of that squeeze, we climbed back into positive territory, which allowed the trend to continue. That tells us that momentum is back in the direction of the trend, and we see that surge to new highs. So after that dip and the retest, it didn't roll over. It found some strength again. So that was interesting, and that sort of bodes well for the longevity of the Go trend in energy.
And if we take a look at the energy sector relative to the S&P, and we're doing our ratio analysis and looking at relative strength, pretty important breakout from a squeeze, and here again at the inflection point on the daily chart.
Yeah, so here's the relative strength, and look how much more normal and natural looking that is. It's really just been higher highs and higher lows since the summer, and that's what we're looking for when we do this relative analysis. That's some pretty strong outperformance to the S&P as a whole. And as you said, right now on the right side of the chart, the oscillator riding the zero line, creating a go-no-go squeeze as price moves off the high that we just hit. So if we get support here at the zero line, we can fairly confidently say that there will be a continuation of outperformance in terms of energy versus the S&P.
Absolutely. Thank you very much for that, Alex. And let's check in on one other sector, the XLI, the industrial sector of the S&P 500. We'll start with the absolute chart, and then we'll work our way back to the relative.
Yep. XLI right at these prior highs from the summer. This is interesting because it looks as if might have failed at those highs, right? So we saw the Go trend return, rise quickly to test those prior highs, and has had a bit of trouble with it. So as we correct and cool off, we'll watch the oscillator as it comes towards zero, and we'll see if this becomes a higher high, higher low, higher high, higher low, and then if this moves on again to test those prior highs. But in order to do that, it'll definitely need to find support at the zero line. If I make this the ratio chart, you can see how this performance relative to the S&P has been, nice and strong. You were talking about it earlier offline. We were talking about that. You were talking about the breakout of relative outperformance really in November, and you can see that here. A lot of choppiness and movement sideways, and then a breakout in November in terms of relative outperformance for some of these sectors, such as industrials. And now we've just cooled a little bit, and we're back at zero on a relative strength basis. So inflection points across the sectors today, but you can see we're going to look for that zero line to hold.
Absolutely. And I mean, breakouts of a range bound channel in price action, certainly breaking out to the upside, it would make logical sense for that to come back and retest the top of the range. Obviously, we're not into forecasting. We want to obey what the trend tools are telling us. And we remain in a weaker Go trend on a relative basis for the industrial sector. But as we explained in great detail on yesterday's StockCharts TV exclusive, that go-no-go squeeze is beginning to build, and it's an all-important volatility compression that will signal to us, right? We want to trade in the direction of the break, and that can either be a trend continuation signal or a topping pattern and a trend reversal. So for anybody who missed yesterday's special, we encourage you to head over to GoNoGoCharts.com and take a watch for free to yesterday's special. Alex, happy trails to you, safe travels, and looking forward to having you back stateside next week.
Yes, sir. See you soon.
Be well.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.